Welcome to the Baldwin CPA's webcast, CARES Act Protection Program Forgiveness. Over 1.6 million businesses and nonprofits received funds from the Paycheck Protection Program as a part of the CARES Act to keep workers employed amid the pandemic and economic downturn. The Paycheck Protection Program loans give organizations the opportunity to have the loans forgiven if borrowers maintain their payroll and comply with specific reporting requirements. During this webinar, we will walk you through processes and documentation, best practices to maximize the opportunity to have your Paycheck Protection Program loan forgiven. Our presenters today are Baldwin member Lisa Foley, CPA, CGMA, and accountant Matthew McKirahan. And at this time, I'll pass it over to them.
Thank you, Leslie. Glad to see so many people participating today. We're glad to put this on. It is a turbulent time in planning for this, and I know we put this off till Friday, hoping we would get some additional guidance. That has not yet happened, so we'll go over the things as we understand it, but as most people know, things have been changing daily as guidance comes out. So we have read the act through and through and believe we have a good handle on the requirements. And if things change, we will definitely have another webinar, keep this updated through social media and our website. So just want to kind of throw that out because we're kind of going out on a limb. We've watched some other webinars, and I think I've been on 3 webinars this week, and there's been 3 different calculations. So until we get some really clear guidance, it's probably not black and white for anybody right now, but I think we can go over the highlights and how we think it reads at this point, and kind of give you some ideas of how to plan and be prepared, because what we have learned through this process is that you can't start planning for this 4 weeks in. And I know a lot of clients that we've worked with got their money 2 weeks ago today. So we're already really 2 weeks in at this point. So I'm glad to have everybody on. And, you know, one of the things that's not updated on here is Congress did approve, I think President Trump is expected to sign today, additional money into the program for those that didn't get to participate before the funds ran out. So they have allocated $320 billion more dollars to the program, and then they have put a caveat in there that $60 billion of that will be dedicated to smaller banks. Of that 30 billion will go to banks that are in the asset size of 10 to 50 billion, and then the other 30 billion will go to community banks that have assets less than 10 billion. So that should help some of the smaller applications get processed, but they do anticipate, and I agree, this money will go much faster than the first time, because we changed applications for people about 3 times in trying to get them put through as the rules and guidance was changing. So, and the reason it dried up so quickly towards the end of the first allocation was the big banks finally got their online systems. And as soon as they got online, that money dried up really quick. What I will say is a lot of our clients, surprisingly, that have worked with the smaller banks had probably a higher success ratio than the big banks. The big banks just didn't get things processed as quickly. And we've got some clients that have big applications out there that we've been promised will get through in the beginning of this. So we will see. There's no word on when that's going to open up, if that'll be today, over the weekend, or Monday. So we'll have to keep our eyes peeled on that. But that's kind of just an update of what happened last night, and kind of a caveat of how we've interpreted the act at this point until we get further guidance. So we'll go ahead and get started. And please ask questions. I know Matt and I have done a couple of these now, and we will try our best to get to as many questions as we can at the end. Because we're going to go through some detailed calculations. I'm going to go through some things, some overview, and then Matt's going to walk us through the detail. We have developed a spreadsheet to help our clients track their spending to kind of see if they're on pace for the forgiveness. So he's actually going to show you that spreadsheet and walk through some examples with it as we move through the presentation this morning. So just some guidelines to understand where this started and where we've been. They issued the final regulations on the PPP program, interim final on April 2nd, and they stated we would get more guidance on the loan forgiveness. And as of today, like I've mentioned, we don't have any of that guidance yet. So I think all the guidance at this point has mostly been focused on the application process and not the back end forgiveness. So we are still awaiting that, and we'll keep you updated as we get information. The forgiveness, if you jump through the hoops, the full principal amount and any accrued interest can be forgiven. The assumption is that you're going to have to use it all. If you're going to get $200,000, you're going to have to spend that $200,000 to be forgiven. So just kind of keep that in mind. And there's going to be ways, and we've got about 3 rules that you've got to meet to accomplish that. So as we've talked in our previous webinars and with our clients one-on-one, the loan proceeds have to be used for payroll cost, payments on your interest of a mortgage obligation, rent payments, and utilities. So that's the broad-based rules of what you have to spend it on. And as we get more into it, that will be 75%, has to be at least 75% payroll, where you can use 25% for those other things. The employee and compensation levels must be maintained. So that's going to be the other 2 rules we're going to walk through today, that you have to have your FTE count up to where it was in February. And you also have to make sure you're paying people at least what you were paying them then. So those are kind of the overarching rules. And then, we just want to alert everyone, banks were figuring it out as we went on the application process, just like we were. They are privy to some more communication from the SBA than we would see as practitioners and customers, but they were very much learning like we were in a very quick-paced environment. So the forgiveness, we've got 8 weeks, and then they're going to have time to develop that scrutiny a little bit more. And I expect that the back-end compliance is going to be much more involved, and it really will be monitored by the banks. So your lending institution is the monitor of that, not really the SBA. So just kind of keep that in mind. So the expected loan forgiveness amount is going to be the sum of all your forgivable costs. That's going to be your payroll, interest, rents, and utilities that you incur within the 8-week period following the date of the loan. So your loan date is going to be the origination date, should be the date that you sign the documents and cash the check. I've had a couple instances where I think, the bank only, once the bank gets approval, the bank only has 10 days to get that loan closed. That is in the regulations. So I have seen a couple maybe that have signed a couple days late on the documentation date. So make sure you really look at your loan documents and see what that date is, because that's when your clock starts on the 8-week period. And just as a reminder, payroll cost, it is your gross payroll. So wages, bonuses, tips. You can only count payroll on one person up to $100,000. So kind of keep that in mind, that if you can only take the 100,000 divided by 52 weeks times 8, each person can only have 15,385. I know we're going to talk a little bit about giving bonuses to meet the compensation levels, but just realize if you give somebody a bonus and it kicks them over this 15,000, it's not going to help you any. So that's very important to remember. Healthcare cost, that is defined in the Act as group health care. So it would be the employer portion of your health care. Your contributions to retirement plans, those count in your gross payroll. That's going to be the employer match. And I think I've got it on a later screen. We'll talk about profit sharing because there's a little bit of uncertainty there. I've had that question already come up by several clients. And then also your state unemployment that you pay. So luckily, the state unemployment that's being paid here for the first quarter returns, if you got your money in time, you've got to pay that by April 30th. So that should give us a little bit of boost in our cost that will help because the first quarter is always the heaviest amount of that. So some things that I've alluded to that are open questions that we just really don't have and get some guidance on is interest. You know, it refers to mortgages, but there's been a lot of people out there that have questioned this and how deep will this go? Can equipment loans count if it's secured? So that's something we're really going to watch and monitor and get communicated out to everybody is really what is the definition of that interest? What all can we include? As I mentioned, retirement. Can your match and your profit sharing be front loaded? I know I've got some clients who don't pay their match until sometime in the summer before their extended deadline of September 15th. So are we going to be able to count that whole match if we go ahead and pay it now, or if we do a profit sharing, is that going to be able to count in our gross payroll? As it reads, the act is very simple, and I would say yes, but there has been a lot of talk about that they may make this number be prorated over the year, that you can't just dump that in there. So that's something we're going to be monitoring closely to give everybody guidance on. So what I would tell you is, you know, don't do those things right now. If you've got that 8-week period to do it, let's let some guidance fall in place and before we make that, and get that in writing so we know if you can do that, because that would be a great way to up your payroll cost if we can do that. Third bullet point, related party costs. That's been a big topic, a lot of calls, a lot of conversations about that. Can I hire my family? And, you know, in some cases, I've talked to businesses that they can't get some people to come back to work, which is kind of a big problem right now in talking with our clients. So they've had to hire some family members to help. The act does not specifically exclude that as it's written. We're just leery about if any guidance comes out, is that going to change? And then also we've talked about a lot of clients have related rental companies. You know, can you prepay some rent or increase your rents a little bit to help you meet that 25% forgiveness area? And again, it's just open questions that we just don't know. There's also been a lot of discussion about what all's included in utilities. I've probably taken that call 10 times this week. And to be honest, we really don't know. You know, there's some guidance out there that says, oh, it must be a public utility company that's subject to the public service regulation. But that is not in the act. It just says utilities. So if it doesn't have to be a public service company, can we count internet? Can we count cell phones, cable, trash? We just really don't know. So that's something that we'll have to monitor, and we definitely will, as we get answers on that, we'll make sure we share that with you so you can kind of update your calculation, your ongoing calculation of what you've spent to make sure it's accurate. Another item that's got some, you know, this is really an important one because the statute states that the cost is incurred and payment made during the 8-week period. So what do they mean by that? To us, we interpret that as it's a cash basis item, which could be good. I had a client, you know, coming that paid March commissions in April. So we really wanted to get that payroll in their covered period of the 8 weeks. So because that's when their payroll was higher before their operations had to be shut down or halted or, greatly reduced. So as we read it, we think that it is actually cash paid, which is going to maybe take the need that as you're tracking your payroll cost, if you're on a bi-monthly or bi-weekly payroll, you may have to pre-run a payroll and just do a 1 week payroll and get it cut in your 8-week period if this holds that it's incurred and made. So just keep that in mind. You may have to be flexible with your payroll if you need that extra week to help you meet your payroll cost in the forgiveness amount. And then the last item on open questions that I wanted to bring up is, I've gotten this question quite a bit too, is the loan tax-free? The Act says yes. And I also read this morning, there's a 112-page tax committee explanation out there. And it's like the Act was only, a few pages, but we've taken the tax portions of it, and they've already issued a 111-page briefing on some of the tax aspects. But it does reconfirm in there that if the loan gets forgiveness, it'll be cancellation of debt income, but it will be tax-free from an income tax standpoint. So that's really important. The question that's out there for all of us tax people is, there is also a code section in the IRS regulations that says if you expenses that are paid with tax-free money are not deductible. So if that's the case, because it would be kind of double dipping to not pick up the income but still get to deduct the expenses. So I feel like that will probably come out and say you can't deduct the expenses you pay with it, but we'll have to wait and see on that. But again, I'd rather get the forgiveness of the loan and pay tax on 30% of it than not get it at all to help your operations. So keep that in mind. That's something we really think. All those items are just really unknowns right now, but we definitely will monitor them and let you know as soon as we get any clear guidance on that. All right, so that kind of is an overview of the thinking and the conceptual part of it. I'm going to let Matt run through some of the detailed calculations. We've got examples, and then we'll also show you the spreadsheet at the end of how you can track it on your own. So Matt.
I appreciate that, Lisa. I just wanted to give a quick tidbit here. We do see the questions in the chat, so please feel free to continue to put those in there. Like I said, we'll have probably about 10 to 15 minutes of Q&A at the end of today's session, and so we would love to be able to get to those questions. And if not, we will also post this webinar to our website along with an FAQ with the questions that you've asked during this session. So just wanted to send out that reminder as we get ready to dive into the details here a little bit. I know there will probably be lots of questions, which is completely understanding. We as practitioners have a lot of questions as well due to the broad language that is used within the statute. And so please feel free to ask those questions, and we will definitely try to get those answered as soon as possible. That being said, really want to walk into the three main reduction provisions. And so I've kind of classified these into three main areas that the Act separates into. So in the latest regulations on April 2nd, the SBA came out and really honed in on this 75-25 provision. And I call it the 75-25 rule. And so they really have stated that 75% of your forgivable expenses must be used on payroll costs. Now, there has been some scrutiny going back and forth and saying, okay, if we want to, how do you calculate that forgiveness amount? Is it based off the forgivable expenses that are included, or is it based off the loan amount? We have looked at this, and so, like I said at the beginning, Lisa mentioned that the overarching goal is to get 100% of the loan forgiven. Therefore, you need to take this calculation, the 75-25, and in our opinion, base it on the loan proceeds you received. Otherwise, you're going to have funds due at the end. For instance, if you have a $150,000 loan that we only used $120,000 of payroll costs, interest, rent, and utilities, you're already got about a $30,000 payback that is going to be due to not using the entire amount. So we would recommend our clients make sure that we've got a plan in place to make sure we spend all those funds and then apply this rule to that. So if that's the circumstance, then you want to make sure 75% of your loan is used on payroll costs. And we'll dig into that here in a little bit. The second one, the full-time equivalent provision, the Act states that you're going to have to maintain, or if you've already let some go, bring back employees to get your full-time equivalent level back up to a comparable period. And there's a couple options for that comparable period that we'll talk about. And the last one is the employee salary and wage provision. And I know this was kind of read over at the beginning when we first received the regulations, but has really become a hot topic here because once you start digging into the calculation, and we'll see this as an example in our spreadsheet as well on the slides here, but you're going to see some reductions amount that are just going to occur due to comparing 8 weeks of our cover period cost to a 12-week period. And we'll get into that. And so high level, that is going to be one that we're really going to want to look at and also make sure that we plan accordingly to meet that so we don't have a reduction in our loan. So moving into the 75-25 rule. So as I mentioned, at least 75% of total forgivable expenses must be spent on payroll. So I got a couple examples here. And I'm not saying that if you don't reach the 75% that no part of the loan is forgivable. That's not how the statute reads. I believe that it just reads that you will be limited on your forgiveness amount to potentially just the payroll cost and will not be able to include the other items unless we reach that mark. There will be some kind of reduction. Like I mentioned, we're still waiting some guidance on that, but that's how we read it as of now. So kind of looking at the example on the left, if your total loan amount was $150,000, we want to make sure we reach that 75% mark for payroll costs. And so you can see on the left that we've spent $120,000 on payroll, $10,000 on utilities, and $20,000 in rent. And so you would look at your percentages and make sure that we've kind of met that 75-25 rule. And we're good on that first example. We've met the requirements and we'll move on to the remaining two reduction requirements. And so I just want to give you an example on the right. The total loan amount is $150,000, but we did not reach our included payroll costs of 75%. And therefore, we believe that you might be just limited to the payroll costs and that the other items that was spent would not be forgivable. And so I'm still waiting guidance on that. We're hoping that they push that out as soon as possible so that we can make sure we tell you all that what needs to take place. But I do know on the front end, due to the rush of trying to get the funds, a lot of the loans and calculations were done, and not saying it was done in a rush, they were accurate, but when you stop and look at your actual loan amount and you look back and see, okay, how am I going to reach that 75% payroll number? Sometimes it might be a challenge. You might already think due to your employee levels now or the pays that's being appropriated, it could be hard to get to that 75%. So just want to make sure that we pass along the information to look at that to make sure that we're planning on, one, spending the entire amount of the loan proceeds, and two, making sure we meet that 75-25 rule. I want to take a little bit of time to talk about this full-time equivalent requirement. And so the actual calculation itself is to take the entire payroll cost number that we've accumulated over our 8-week period and then multiply by this little mini calculation within the formula. And so what you're really looking at, one thing to make sure is that we have to do this on a week-to-week basis. And so we have to calculate these FTEs per pay period. And so one thing that we've done in our spreadsheet is we've helped you go ahead and get your dates in there for when your loan origination date started. And then we've calculated those 8 weeks for you to really go able to say, run a payroll register, here's my FTEs for that week. And it really helps you get to these averages to help you really understand, am I going to meet this requirement or am I not? And so you've got two options to compare your 8-week average FTE by. The first one is the average number of FTEs per pay period from February 15th through June 30th, 2019. And so in our spreadsheet, you'll see that we've gone back and calculated the number of weeks that are in there, that period, and really given you some detail to be able to put your number of FTEs in that calculation to create that average for that time period. And then you have option 2, which is the average number of FTEs per pay period from January 1st, 2020 to February 29th, 2020. And so depending on the state of your business at those time periods, either one is going to probably be more beneficial than the other. And so the spreadsheet has a formula built into it where it'll take the best one available to you. So we would recommend that you go ahead and do both calculations, unless there are some underlying knowledge that perhaps we've grown since last June. And so the January 1st through February 29th is going to be a higher number, then we're probably going to want to lean towards last year's number. But if it could be the opposite, I mean, if we for a seasonal employer, we've got a lot of employees during that time period, maybe January 1st, 2020 through February 29th would be the best option for us. But our spreadsheet will kind of help you walk through that. But the goal is to be at 1 after the calculation. If we're not at 1, then the formula based on the percentage of FTE decrease will decrease the amount of loan forgiveness that we will have available to us. And we'll kind of look at that as an example here going forward. And so then we get to kind of the real tricky reduction requirement, and it's the 25% reduction in wage requirement. And so I've kind of put a little snippet of our spreadsheet up here to help kind of walk through an example of how this is going to work. And so the statute requires that we have to look at what has been paid and the amount earned per employee for the covered 8-week period. And then we have to compare that number to the most recent quarter, finished quarter in 2020. And so if you've gotten your loan proceeds here in April, obviously that first quarter is going to be the first quarter in 2020. And so we're going to be comparing, and this is where it gets difficult with what the statute says. As it is written, you would be comparing an 8-week covered period versus a 12-week first quarter in 2020. And so when you start putting those numbers together in your head, you can realize that you're already going to be at about a 33% reduction just on gross amount earned during those time periods. And so it's going to you got a tricky calculation here. And like I said, we are diligently waiting some additional guidance, because this, as it is written right now, there are going to be reductions amount per employee that we're going to have to look at. And so I want to walk you through an example here on the left. So you've got employee 1. You're going to have to look back at their 2019 annual compensation. And one of the reasons you're going to do that is because if they're already over $100,000 annualized salaries for 2019, they are not going to be included in this calculation. That is due to them already meeting the minimum threshold amounts of about $8,300 per month, because if you take the 100,000 divided by 12 to get your month average per pay period, it comes out to roughly $8,333. And so that's the cap. And that cap was the same cap that was used when you calculated your payroll loan on the front end. And so it's also being the same here on the back end as well. And so we look at 2019 annual compensation for employee 1. They're at $65,000. They're not excluded due to being over $100,000. And so then we would move on with our calculation. And you're going to want to look at 3 different time periods of gross wages, because that's the number that we're using for payroll costs. And so, like I mentioned, you're going to have to compare these to the first quarter in 2020. And so you're going to look at your year-to-date gross wages earned as of March 31st. And so you would take that period from 1/1/20 to 3/31/20 and drop in an employee's gross wages. In this instance, it's $10,000. And then you're going to want to look at the gross wages as of the date you got your loan. And so in this example, it's $11,000. And the last one there is you're going to want to look at the year-to-date gross wages earned once your 8-week period is up. And so I know we're not going to know that number off the front end. And so we've created a formula to help you basically take your 16-week average, the time period from 1/1/20 perhaps up to April 15th, that would be 16 weeks, and then project that to an 8-week earnings. And so that would be the amount earned during the covered period, which is $6,000 for employee 1 there. And then you're going to do a percentage reduction based on the look back period. So you're going to take that amount earned, which is $6,000, and compare it to the first quarter of $10,000. And so you can see right there, that's a 40% reduction in wages. And part of that 40% is due to looking at an 8-week period versus a 12-week period. And so the statute, we think after we have read it, they look back and they realize that, yeah, that's going to be a decrease overall, but they didn't give us the entire amount of the decrease by comparing 8 weeks to 12. And so they kind of it looks like to us that they came back and said, well, we're going to give you this 25% allowed reduction. Well, if you were to look at the calculation, I wish they would have given us 33%, because if a normal salaried employee was earning the same amount during those 8 weeks versus the 12, if you gave us 33%, we'd have zero reduction. But in this scenario, in employee one, you've got a 15% overage, meaning we were allowed 25%, but we're at 40%. And so there's a difference of 15% that's going to be calculated in a reduction amount. And so the reduction amount there, the $1,500, is calculated by taking that difference of 15% and multiplying it back to the first quarter of wages. And so you're going to get a reduction amount of $1,500. Now, we've started working with our clients on this, and I've had a few clients that we've gone through every single employee, 25, 30 employees, and there's a reduction on every single one of them. And so I know Lisa had mentioned earlier about perhaps somehow increasing costs. And in order to do that, we would recommend that we look at these reduction amounts and perhaps divvy that up over the 8-week period to help increase our payroll costs. You're doing that twofold. One is to increase your payroll costs to get to 75%, that first rule, so that we can get it forgiven. And then two, you're helping reduce the reduction amount per employee. And so there are a couple ways to do that. You could increase pay based on hours to get that reduction amount down, or what we've kind of recommended is really taking a look at it in week 3 and in week 7, and maybe looking at it in 2 different time periods. As if you've got hourly employees, whether they work overtime or not, you're going to have a better feel by week 3 going into the first month. And the reason we say week 3 and week 7 is because, remember, we can say we had a $5,000 reduction amount at the end of our 8-week period. But if the employee has already earned $4,000, if we go and give a $5,000 so-called catch-up bonus to reduce our reduction amount, we're going to be over the allotted $8,300 that we can make a month due to that $100,000 annualized cap. And so we've really kind of recommended our clients and those of you on the call to look at it in a 2 time period perspective, perhaps week 3 and then week 7.
Matt, and I may just mention something there. I know we've talked to some clients and we've had some clients do this. You know, some of what has come up is maybe some of the businesses you're in has greater exposure to the public. If you're an essential business still open. And so I think I've heard that Kroger has, for instance, offered a little bit of what you might deem as hazard pay during this time. So it may be that you do increase somebody's hourly rate during this time frame to compensate for that. And I guess this is the part of the calculation we have really struggled with because it just doesn't seem right. And I hope in guidance they clear this up and make this a little easier to meet. But as we read it now, this is kind of how it stands. So Matt and I have talked a lot over the last several weeks that, you know, the goal of this was to keep money in the hands of employees and keep the economy going. And that was the goal of this, keep them off unemployment, keep money in the economy. And so we don't know if that was the thinking behind this or they pushed this out and didn't really work through the details. But this is the part of the calculation. The other 2 we talked about, I think, are pretty easy to, you know, maneuver through, but this one is the one that's going to cause a lot of headache and a lot of time to look at this.
No, very good points, Lisa. And so, like she mentioned, it's just going to have to take planning. Get in contact with us, get in contact with your advisor to really make sure you look at this because there's going to be some due diligence that needs to be done on the front end before we get to week 6 or 7 and we're going to realize that we have maybe a $30,000, $40,000 reduction in our loan forgiveness amount. So just moving down there, employee 2, you can see that there's just kind of an X for the box that we've made over $100,000 in 2019. And so we are not required to do this calculation for them. And then employee 3, you can see going from left to right after working through the calculation, their reduction was 7%, and that is under the allotted 25%. And so we don't have a reduction amount there. So some really tricky calculations, really detailed calculations that are going to take time to hold together to make sure we're looking forward to the end of our 8 weeks, so we can make sure that we're not getting a reduction that could be a potential large deduction if we don't know on the front end.
And I guess what we should mention, Matt, that we haven't is that, if you have that reduction, it will turn into a loan, right? And you will pay it back over, the loan is a 2-year period. So it's just not eligible for forgiveness, but it can still be, it's a loan amount at 1% for 2 years. And I think most of the loan agreements I've seen, and I guess each bank maybe could be different, I'm not sure, but the ones I have all seen, your loan agreement has a monthly payback based on the full amortization of the loan. And my understanding is that they will just, hopefully, there's been some discussion that the banks may try to leave that amortization at the full amount, so you would be paid off a lot quicker. But in talking with a couple bankers, my understanding is that they will re-amortize that loan on the unforgiven part at that end of that covered period, and you would pay, I guess it would be, so we get to defer it for 6 months. You don't make any payments for 6 months. And so I guess it would be deferred, over 18 months, and they would change your amortization at that time.
Another very good point. And so I just really wanted to take a little bit of a time break here and go and look at our perhaps Baldwin forgiveness calculator. And so I'm going to switch screens here real quick and actually share our spreadsheet that we've created here at Baldwin to help our clients and any of those who need it. So I'm hoping everybody can see that. And I've switched over to our actual spreadsheet and have put an example of here, kind of following our example of the $150,000 loan. And so you can see at the upper top left, you're really just kind of putting in your loan amount information. And what's going to be important is row 4 and 5, the loan origination date and the end of the 8-week period, because this is going to be your 8-week covered period. And so that being said, you would then start tracking week by week. And we recommend you doing this week by week, obviously due to the reduction calculations that we've talked about before. But this allows you to really plug in your information each week and to keep track of it in real time as we go forward before you get to your 8 weeks. So if we have to make any decisions, we've got the necessary information to make those decisions off of. And so just kind of working left to right, we've got our gross payroll here at the top that we would include that comes from a payroll journal. When talking about the scrutiny of how the loan forgiveness is going to be kind of monitored at the end of this, we've also put some notes in here of things that perhaps you might need copies of to make sure that we can substantiate those expenses that were incurred during our 8-week covered period. So payroll journals, I've talked with a couple of bankers that are going to be key to determine your gross payroll costs to be able to tie to those numbers. Then you can add your group healthcare insurance, vision, dental, etc. Just making sure we've got copies of those invoices, and if we need to have some calculations done per employee basis, we can work on those as well. But this is really geared towards helping create a summary sheet for your entity, your business, or your if you're a sole proprietor yourself, in terms of how we can get to our forgiveness amount. And so just really want you to kind of keep looking at it on a week-to-week basis, but really want to get down here to our calculations where we have gone ahead and put in what those reduction calculations are. And so you can see based on this example that we've used up top, based on our grand totals before potential reduction of forgiveness, we spent $20,000 in rent, $10,000 in utilities, and then $120,000 in payroll costs. And so we meet the 75%, 25% reduction rule. And so we're over that and would move right into kind of the 8-week rules or the FTE calculation and the wage reduction calculation. And I'm going to scroll over here a little bit just so you can see that we've went ahead and pre-populated these periods or pay periods that you might look at. If you're getting paid weekly, it is based off of weeks. And so you can see right here in our first column, that is your 8-week average during your 8-week covered period. And so you would put in your FTEs. One thing to note, an FTE, according to the SBA, is anyone who worked over 30 hours per week or over 60 hours if you're getting paid bi-weekly. And so I've had a couple conversations with clients that perhaps if you've got part-time employees and perhaps they're working 24, 25 hours, it might be very beneficial, for one, to help you get to that 75% of payroll cost over your entire loan amount, but two, it's going to help you in your FTE calculation if you go ahead and increase them to potentially 30 hours to make that mark. Also note that if you don't do that, the two of those full-time equivalents, part-time people, would become one FTE, because if you add their hours together, they would be over 30, and so they would each represent almost a half and would become one with the 15-hour overage on each of them. So just something to note there. Will be important in calculating those as well. Also potential to make some changes there if we need to. But you would take your 8-week average here and then compare that to our option 1 and option 2. And those are the time periods that we mentioned, 2/15/19 through 6/30/19, and then 1/1/20 to 2/29/20. So in this example, you can see that our average FTE in 2020 was 40. And then looking at the two options after getting that calculated, our option 1 is not really going to help us if we look back into 2019, because our average FTE during that period was 41. But we can take option 2 because in that time period, our FTE average was 38. Therefore, we meet the FTE requirement and there is no reduction on our loan forgiveness amount. But if I were to change this to perhaps maybe, I'm just using an extreme example here, 10, you can see that we'll be able to calculate what our reduction would look like. And so our average FTE in 2020 is now 36 during our 8-week covered period, and neither one of our options help us. Now this formula is geared toward to take your option that is best suitable for you. And so we would be looking at the 38. And so you're taking your 2 FTE reduction and you end up getting to a reduction amount of about $6,000. And so just some good examples to walk through so that you can see how this is kind of going to work. And we'll make sure this is put on our website. So if you need to use this tool, you sure can. And this is obviously geared to help those walk through this part, the PPP part, that not a lot of people saw at the front end, but we knew it was going to be a little bit trickier on the back end. And this is just a way to help with that. I'm going to switch to the second tab here, so hopefully everybody can see here. So the last reduction requirement is the reduction in salaries. And so this mirrors and mimics the, the slide that you saw earlier, just going across, but then you'll get this reduction amount and it will populate into your loan forgiveness amount here over on tab 1. And so you can see after we've gone through the calculations in this example, we spent $150,000, but we had a wage reduction limit on 1 employee. And so our maximum amount of loan forgiveness would be $148,500. And so it's really geared to help you kind of come along and be able to make decisions as we go forward. Lisa, is there anything you want to add while we're here on the spreadsheet before we go back to the slides? That being said, let me go ahead and move back to the PowerPoint.
You know, one of the things that I've seen some questions pop up and just, well, go ahead and what if we can't be open? And what if we're at reduced employees? Are we going to get hit by this? And there is in the act, there's a little catch-all that says if you have your FTEs back up to where they were before by June 30th, the FTE calculation will not apply. But we really just don't have a lot of guidance on that. I've seen it interpreted many, many ways because the problem is, okay, we don't meet that. I think when everybody read it originally, they thought that meant none of these other tests apply. that is really not how it reads. So, okay, if you don't have to do a reduction because of the FTE assessment, because you meet that one-time rule, and I think that's aimed at, restaurants and salons and things like that, the rule about spending 75% of it on payroll is still there. So that rule doesn't really help you in a reduction format. So everybody at first thought that was great, and that's going to make this easy, and we don't have to worry about it. As long as we're back up to where we were by June, none of this matters. But that's really not how it reads. And so that is one of the guidance areas that we are desperate to see what that looks like, because I've got clients that don't know if they should go ahead and bring their employees back and pay them not to work, as odd as that sounds, so that they're spending the money, or in that case just leave them on unemployment and know you're going to pay part of it back. And that's the decision people are having to make at this time until we get more guidance, and we're 2 weeks in and we don't know. So it's very hard to give you advice because we just don't know. But that caveat is in there, but I think Matt and I agree that it really only helps you on the third bullet point there. It doesn't really help you on the second and fourth one, right, Matt?
That's correct. Yeah. That's something very important to mention, that we're still awaiting guidance, because like I said, these calculations are tough when you get down to the details. And so they just have not put that many details within the statute to be able to help explain what's going to happen. And so, like Lisa mentioned, we're extremely eager to get our hands on those to be able to either make adjustments as needed, or if it is the way that it was intended from what we've read, then we're going to need to make some adjustments with our clients to really look forward to the end of the 8 weeks. One thing I think it's important to mention while we're getting close to our question time, is that I think the intent of this PPP program, and you've heard it throughout, perhaps President Trump when he's talking and things of that nature, but the goal of the PPP program, after you read the act, is to really make sure you've got your employees back up and running. So you've either hired them back, or they're working with you, or gearing up to be ready to turn the corner once we get to June 30th. That's really kind of what it looks like, to be able to make sure that we can really hit the ground running June 30th. And so this is a way also, I know we've talked to clients about combating the unemployment increases that came through the CARES Act as well. And so if that has to be done through this PPP program to maybe increase payroll for these 8 weeks to incentivize them to make sure they're back and ready so that our business can turn that corner as quickly as possible, then that's something we might need to look at. Just some key takeaways here, just kind of summarizing a little bit of what we've gone through over those heavy detailed slides. We would recommend that you'd want to spend the entire amount of the loan proceeds. That way you don't have an amount due come at the end of the 8 weeks. That would be over that 2-year maturity period for the loan. Make sure at least 75% of the loan proceeds are spent on payroll costs. And then we would really recommend you go ahead as quickly as possible, complete the FTE assessment and that wage reduction assessment, because you're going to be able to get a good expectation of where you're going to look like in 8 weeks based off of some projections. And that spreadsheet can help do that. Lisa or I can help you do that, and we would for sure be willing to do that. Lisa, I think that's about it, unless you have anything else to add before we go to questions.
Yeah, I get it that it's a lot of heavy lifting, like Matt said, and we're here to help. It's a lot to take in, and I guess as I would say, free money always comes with some strings attached. So there are some application process and some decently heavy compliance to work through, but we feel like if we're proactive here in the first few weeks and get our arms around it, nothing should be a surprise when we get to the end of the 8-week period. So I know there's a ton of questions. So Matt, if we want to jump into those, that would be fine.
I'm going to scroll to the top of my chat here. So I'll just try to, it's pretty large. So we're just going to try to grab a few here from the time we have left. But like I mentioned, we'll make sure to get an FAQ out out there that you all can make sure to read and make sure your question is being answered.
Matt, I know one that I saw pop up a lot while we've been talking is you want to talk a little bit about how you prove the forgiveness part on a self-employed person. That's something we don't have a whole lot of guidance on, and that we're anxiously awaiting that. But I think the calculation is going to be a little bit simpler, don't you, Matt?
Yes, it will be. One of the, I believe it was an FAQ that came out around April 14th or 16th, somewhere in that time period. They did talk a little bit about what that would look like. And so the funds for the PPP program can be used as a wage replacement is the kind of the wording they used in that FAQ. And so, because due to having to calculate the loan based off your net income on your Schedule C or your 1099 for 2019, the funds that are going to have to be used is basically as a wage replacement. One thing to note, you can't use the proceeds for rent and mortgage interest if those weren't already included in your 2019 Schedule C. That would be one thing to note. And so a lot of people, for the independent contractors and sole proprietors, will use this basically as a wage replacement. Lisa, does that sound about right?
I think, what we haven't seen is if you actually have to show that self-employment person taking a draw out to another account, or you just have to prove your net income during that time with that money coming in as income. We're really not sure, but we will definitely address that as soon as there's some more guidance on it. But that has been a question a lot of people have had.
I see a few questions here asking about 1099 workers. Lisa, do you want to kind of jump in on that one?
Sure. So there was a lot of confusion about that, but this is based only on payroll costs. So if you are paying people via a 1099, that does not go into this calculation of payroll costs. I think the confusion came about in trying to make people understand if they're the recipient of a 1099 and are self-employed on their return, that they can apply on their own. So there is no deduction in your payroll costs for 1099 contractors. They have to go file on their own. You don't get credit for that.
I see a question on here. I paid last month's LGE bill. Once we got the loan, can I include this in the utility costs?
Again, that's going to go back to that. And I think, yes, it goes back to that. How are they going to define? Are they really going to hold to the incurred and paid? Obviously, you couldn't have, if that service time was before your loan date, they could maybe say that expense wasn't incurred in that area, but you paid it. So if you have to meet incurred and paid, like the acts kind of suggest, then it would be no, but everything I've seen is seeming to lend to a cash basis on that item.
I see a question on here. Is the 8-week period flexible? It is as soon as the date on the loan document. So the date of your loan origination, that is when your 8-week period starts. So it is not flexible as of now. I know, Lisa, there has been people definitely lobbying to help the restaurant and salons and those that have been affected by executive orders given down by the governor to shut doors. But as of now, that is not flexible. It says funds were received this week, but payroll was ran out of a different account because it wasn't received in time. Can we transfer funds from PPP account to other account and still count towards funds used for payroll?
You don't have to do that. That's a little bit of a misconception. The act does not have to say you have a separate bank account and keep these funds separate. I think a lot of banks, even the AICPA, have encouraged that because they think that will make it easier to track on the back end. But if you have a good accounting system, all we have to do is prove those expenditures during the 8-week covered period. So you do not have to have a separate account for this money. That has been out there as an encouragement that, maybe it'll be easier to present to the lending institution. Here's all the money and how I spent it because it came out of this one account But again, I feel like we've tried to help our clients have a sophisticated enough accounting system in QBO or, internal software items that we'll be able to prove the expenditures. It's really based on the date of the expenditures, not what account it comes out of.
Question here, can payroll include the cost paid to a temporary staffing agency that is used for labor?
There are some special rules out there for PEOs that there's not a lot of detail out there, but I do think I read, Matt, you correct me if I'm wrong, but I think I have read that if you are using that you can count that in your payroll cost.
That is correct. Yeah, I saw that question and I thought we'd highlight that because that is something that I know some clients are dealing with. And so, yeah, I agree that would be included in your payroll costs. Question on here, can we pick option number 1 or option number 2 at this point, or do we need to use the FTE number on the application? No, you will get to choose which option. You get the option to choose either option 1 or option 2 with regards to the FTE calculation. So either looking back into 2019, almost looking at your second quarter in 2019 versus looking at the 2 months at the beginning of 2020.
Yeah, I think that application was a little bit confusing. I know some at the beginning that were filed incorrectly because it didn't define what that number of employees meant on the front. So because it was part of the application process, a lot of people looked at that was just proven you had under the 500 employees in the application that you qualified for the loan. So you are not held to the number that was on that application in any way.
I'm just looking through here. I know we're getting ready. We're probably over our time limit, so we'll probably take one more and then make sure we get these out to you all as soon as possible. Lisa, I'll direct this one towards you. I'm not sure if we know. I believe we might know, but I'm not sure. Does the group health insurance include life and disability paid by employer?
No, my understanding is no on that. It's just group health costs. So health, vision, dental are the examples that I have seen, but and that could come out in guidance down the road, but I have not seen anything that allows us to do life and disability.
All right, Lisa, I know we're running over here a little bit, about 10:02. Is there any kind of closing remarks or anything that we need to look over before we adjourn for today?
I don't think so. Again, I know, I think I saw pop up a lot of times, what if somebody, if you're comparing employees back and you've replaced them with someone else, obviously you're not going to be held to what you paid them. So we're going to have to wait and get some guidance on how you compare employee by employee if those employees aren't there and you have a lot of turnover in your business. So hopefully but I don't think the intent was to penalize you for turnover. I've not seen anything to that. But, just in closing, I think, in our personal lives and business lives, this is a very, very challenging time. And we've had to all adjust and pivot and work differently and serve our clients differently. So, this grant, this forgivable loan process has been something that has helped a lot of our clients. So we just want to ensure that we plan appropriately. We're having conversations, talking about it, and get as much of this forgiven as possible. If it takes a little bit of planning, it'll be well worth it to help keep your businesses operative and ready to go once the economy can take back off. And I think we're finally seeing some signs of some things here in Kentucky might open next week. So hopefully that'll give everybody a little bit of hope, and hopefully we can use these funds to help maneuver through this, and we'll have this behind us. And this will all be a distant memory, but it's a very fluid situation. We will definitely do our best to stay on top of it and help you all in any way possible. If you have questions, I know we've got a lot of participants on the webinar today. Feel free to send Matt and I email, give us a call. We will get back to you as soon as we can. But it may not be today, but if we have some holdover, We'll definitely get back with you at the beginning of the week, and we'll get the spreadsheet shared out on the website for everybody. And we will keep doing webinars. So once we get guidance, we will definitely come back. So watch your emails. And we just want to keep everybody informed. And thank you, Matt, for walking through those detailed calculations. We worked really hard trying to make it as simple as possible in a complex calculation. Do you have anything else, Matt?
No, just want to thank everyone. Feel free to reach out if you have any questions, and look to hearing from you all soon. And have a great rest of your day.
Thank you.
Take care.